a new financial frontier. In 2008, the world watched as Wall Street crumbled under the weight of its own inefficiencies and over-leveraged systems. In the years that followed, innovation flooded into finance. Robo-advisors, mobile trading apps, decentralized finance, DeFi, and blockchain-based solutions. But among the most transformative developments emerging from the aftermath is tokenization, a concept quietly revolutionizing how we think about ownership, liquidity, and asset management. Tokenization is the process of turning real-world assets into digital tokens on a blockchain. These tokens can represent anything of value, from real estate, fine art, and equities to commodities and even U.S. Treasury bonds. As we move deeper into the 2020s, tokenization is no longer just a buzzword. It's becoming the infrastructure layer of a new financial era, one that may eventually rival or rebuild the traditional institutions of Wall Street. What are tokenized assets? At its core, tokenization refers to the digital representation of ownership rights using blockchain technology. Think of it as taking a large, illiquid asset, like a $100 million skyscraper in Manhattan, and slicing it into thousands of digital shares, or tokens. Each token can be purchased, traded, or held by individuals, granting them proportional ownership and rights, such as rental income or dividends. Tokenized assets fall under the broader category of real-world assets, RWAs, being brought on-chain. This includes tokenized real estate, tokenized bonds, tokenized private equity, tokenized commodities e.g. gold, tokenized art and collectibles. Unlike cryptocurrencies, which often represent a native digital value like Bitcoin, tokenized assets are backed by tangible real-world value. This makes them particularly attractive to both retail and institutional investors seeking stability, accessibility, and transparency. Why is this a big deal? Traditional financial systems are slow, opaque, and expensive. Settlement of trades can take days. Fees pile up across middlemen. Access to private investments is often restricted to the ultra-wealthy. Tokenization addresses these problems by offering 1. Fractional ownership. Previously unaffordable assets, e.g. commercial real estate, fine art, can now be broken into microshares, making them accessible to everyday investors with as little as $50 to $100. 2. 24/7 liquidity. Unlike traditional markets that are bound by hours and holidays, tokenized assets can be traded around the clock, across global decentralized platforms. 3. Lower transaction costs. Blockchain eliminates the need for many intermediaries, custodians, clearinghouses, brokers, reducing friction and fees. 4. Programmable finance. Through smart contracts, tokenized assets can automatically distribute dividends, rental income, or interest payments in real time, increasing transparency and efficiency. Institutional players are already in. This isn't just a retail trend. Major institutions are diving headfirst into tokenization. BlackRock CEO Larry Fink has declared tokenization as the next generation for markets. BlackRock is actively investing in tokenized asset platforms. JP Morgan is piloting Onyx, a blockchain platform that has already settled hundreds of billions in tokenized transactions. Franklin Templeton has launched a tokenized U.S. government money fund, one of the first of its kind. Goldman Sachs and HSBC are exploring tokenized bond issuance and real estate vehicles. These moves signal a massive shift. Traditional finance is not fighting tokenization, it's adopting and evolving with it. Real-world examples. Here are some live use cases proving that tokenization is no longer theoretical. Small Blue Diamond Ondo Finance provides access to tokenized U.S. Treasury products offering yield in the form of stable coins, bridging DeFi with real-world debt markets. Small Blue Diamond Realty, a platform that tokenizes rental homes in U.S. cities, allowing investors worldwide to earn passive income in crypto from rental properties. Small Blue Diamond Matrix Doc and Back.fi, platforms offering tokenized versions of U.S. bonds and ETFs with real on-chain liquidity and transparency. Small Blue Diamond Securitize enables companies to issue tokenized securities and has worked with major brands like Coinbase and Avalanche for compliance-grade tokenized offerings. These platforms are breaking down geographic and economic barriers, making global investing more inclusive. The regulatory landscape. With innovation comes uncertainty, especially in regulation. U.S. and global landscape. In the U.S., tokenized assets that represent real-world value are often categorized as securities, falling under SEC jurisdiction. The SEC has begun approving tokenized versions of traditional ETFs, a major green light for the industry. Europe is ahead with MiCA, Markets in Crypto Assets Regulation, which outlines rules for digital assets and tokenized securities. Although the regulatory frameworks are still evolving, progress is trending in a direction that supports compliant innovation, especially when tokenized assets have real underlying collateral and follow proper investor protection protocols. Risks to consider. While tokenization is promising, it's not without risks. Small Orange Diamond platform risk. Early platforms may lack robust security, legal infrastructure, or liquidity, leaving users exposed. Small Orange Diamond regulatory uncertainty. Governments may shift stances or enforce stricter KYC/AML requirements, slowing adoption or limiting access. Small Orange Diamond liquidity traps. Not all tokenized assets are actively traded, meaning some investors could struggle to exit positions without price slippage. Small Orange Diamond overhyped narratives. Some projects may use tokenization as a buzzword to attract capital without true backing or utility, similar to 2017's ICO craze. As always, due diligence is critical, especially when investing in early-stage or exotic asset offerings. The future of tokenized finance. Analysts at Boston Consulting Group estimate that $16 trillion in assets could be tokenized by 2030, including 10% of global GDP. Here's what that might look like. Tokenized real estate becomes a standard alternative investment in wealth portfolios. 401(k)s and IRAs offer exposure to tokenized private equity and debt instruments. Governments begin issuing tokenized sovereign bonds directly to citizens. Emerging economies leapfrog traditional infrastructure by launching tokenized national asset markets. Eventually, everything of value may be tokenized and traded on-chain, with programmable ownership, instant liquidity, and zero friction. In this future, Wall Street doesn't disappear, it evolves. Final thoughts. This isn't just disruption, it's reconstruction. Blockchain didn't come to replace finance. It came to rebuild its foundation, with more transparency, accessibility, and fairness baked in. Tokenized assets are not just a passing trend. They represent a fundamental shift in how we define ownership, manage wealth, and interact with global markets. The institutions have noticed. The innovators are building. And early adopters, whether investors or builders, may stand to benefit most. The tokenization revolution has already started. The only question left is, will you be watching from the sidelines, or holding your share of the future?